Welcome back to the Behind the Well Show. Roger Abel, Elias Randall in studio. How's it going this week, Eli? I trekked back from Omaha last night at 1, so I'm going to let you do the heavy lifting on this one.
Oh, thanks.
You're welcome.
Yeah, I'm doing good. How's your week going?
Mine's good.
Yeah?
Yeah, I had a late night last night, but come in here and film the show.
Good.
Other than that, I'm having a great week. Went
Good
and
to
saw
hear.
some customers over in Omaha yesterday afternoon and got home at 1 o'clock in the morning. Showed up here. I'm ready for the weekend after this show is recorded.
Yeah, it sounds like a long day.
A lot of windshield time. 8 hours in the car.
Okay. So do you want me to introduce the first topic then, or is that what you're getting at?
Well, we were discussing it before we started, so now I know why you were talking about it. Yeah, introduce away.
Well, the headline is 401k plans saw a flight to cash and bonds in September. So this was an analysis done by Elias, which Elias, for people that unfamiliar with the business, is a big 401k custodian. They work with a lot of really big companies, so they manage a lot of 401k plans. I doubt, well, I shouldn't say I doubt. I really don't know. They're probably not as big as Fidelity as far as just company and what they offer, but their flows and the things going on would be a good snapshot of how investors are feeling. So I think this is a sign of people are preparing for, I think it's a couple things. One, people feel more uncertain, which we had a government shutdown, more talk about tariffs. So some stuff going on to kind of influence people to feel that way. We've also had a good, year-to-date returns and equities are looking really good. So there's probably some rebalancing going on. People are selling and just moving some money into bonds and cash, which could be a prudent thing to do if it's not market timing. If you're rebalancing to really rebalance, it's good time to do it. But if you're trying to time the market, that gets to be too difficult, nearly impossible to do. So, and then I also know we've had a few more inquiries through our website about meetings, and my speculation on that is people are feeling a little more uncomfortable about their investments.
Before the show, we were discussing these factors. I think the one that's overlooked is the government shutdown. That actually might be the reason people are experiencing what we would call a flight to safety. They're trying to protect their portfolios, and we've been shut down now for 2 weeks, I believe, correct?
Going on, yeah.
That probably coincides really well with this. The other thing is people believe that the stock market goes to an all-time high and then it isn't going to go higher, it's going to crash. So they try to time the market and get out. They think they're going to time the market. And I would encourage the listeners of this show to click the link in the description and download our guide on how to invest at all-time market highs, because ultimately there are some advantages to doing that. Trying to find the bottom or being a dip buyer likely won't yield better results.
One of the hard things with this bear market right now is it's grinding higher.
You mean bull market?
Did I say bear market?
You said bear market. You mean bull market?
How
did you get home last night?
Correct. I misspoke. I was thinking people are thinking about a bear market. This bull market is grinding higher. We've talked about that over the years where the stock market makes it hard to buy. And a lot of times when it's hard to buy is when you should be buying. So think about an everyday investor. And just in this analysis of 401k flows, 80% is going to fixed income. So you're at work, people are logging into their 401ks. Well, I'm moving to safety. There's kind of this flight to safety, and the market's still grinding higher. Most of the time, that's when you should be buying.
a response to that as well. Alight manages 401ks for the most part. They have about $1.2 trillion under management. So these are not professional asset managers reallocating to bonds or looking at the effect of lowering interest rates and the price to bonds. This is purely, we're moving here because we're nervous.
It's retail.
It's retail
traders.
investors. If you told me professional asset managers were moving money to bonds, my first question would be, what's the duration or how long of a term of bond are they buying? Because the professional asset manager may be predicting lowering interest rates and rising prices on bonds, but that's not what this is. This is retail investors moving to safe assets. And this is the exact reason retail investors typically will massively underperform the stock market. Times like this, well, it's so good, I can't keep going. I remember Elias must have been 2021. We had a family come talk with us, and they said, we just don't think the stock market can go higher. We're really satisfied with where we're at. We just want to put this all in fixed income securities, really safe investments. They've massively missed out. And ironically, they're not even using their money for income. They're not taking any money out. It was literally just so they could take a look at their big pile of money and not see it go up and down. Not only that, they locked in interest rates in 2021 before they were actually higher. I remember the rates they locked in. They weren't the fives. They missed it by a year. They tried to time out of getting the market, get into the fixed income world when you were getting 3.5 or 4. They're already locked in. And once somebody makes their mind up, it's really difficult to convince them differently. And one thing I don't believe we're in the business of changing people's mind. We can arm people and give them tools and resources to make very good, educated investment decisions. But once someone has conviction in something, it's very hard to change their mind.
Here's the takeaways for me from this conversation. With this being an analysis, as you mentioned, that's insightful. This is retail investors. It almost creates a level of peer pressure in every different workplace if this is the common investor behavior. I think back to 2021, the time period you're talking about, and I remember we spent a lot of time telling clients and prospects successful investors don't act that way. And here's the truth of the matter. The successful investor, equity investor, their friends, their family, the people they hang out with, their coworkers could be doing all of these things, and they're going to continue to be a buyer and continue to stay the course. And the folks that do, the folks that do will have a better result over the long term. If your concern is what your result is in the next 6 to 18 months, maybe this makes you feel better. But if your concern is to grow your wealth over time, this is not a behavior that's going to lead to that successful outcome.
This arguably shows the power of having a bucket strategy to give your money responsibilities. When you look at your account as one big chunk of money and you don't figure out what's my liquid bucket look like, what's my income bucket look like, and what money am I willing to just let grow and not even look at for the next 5 to 7 years, you don't make those decisions. It's when you're just looking at your statement and you say, that's my money, it goes up and goes down, and you're not looking at under the hood a little bit to see how all the different asset classes are acting and what the responsibility is for each investment in there. I was chatting with a customer the other day about debt levels and risk. out there and I think this coincides with this conversation. There's a really high level of debt in this country. Our country has debt. We've talked in the show about phantom debt, which is buy now, pay later, our firm and all those different places, which we don't even know how much is out there. People for the last 3 years have used their homes as piggy banks, refinanced their house because refinanced or more likely not refinanced, but took out a line of credit on their house. I just ran by an article the other day that said Gen X, so that's my generation, or 1965 to 1980, has the highest credit card debt by generation.
I was a little surprised by that.
I'm not.
I was.
Here's why. I feel like my generation is the keep up with the Joneses generation. My parents don't care what their friends are doing. A lot of people I know in their mid-50s don't care, but people between like my age, they care.
You think
And then-
millennials and Gen Z are better about that?
Uh,
Do you think millennials and Gen Z have the same
I don't think
keep up
so.
with the Joneses mentality?
I think even more so. So the chart here, this is off Investopedia. The average credit card debt by Gen Xers is about 10,000. Millennials is about 7, okay? Here's why I believe millennials and Gen Z have lower credit card balances.
The credit card limit?
It's strictly just the limit.
Yeah.
If you think
that would
about
be interesting to know is what's kind of the ratio of the debt to the actual limit.
Yeah, because think about your prime earning years. So this is basically people 45 to 65 have the highest balances. Well, when are your incomes the highest?
45 to 65.
I believe 53, I think, is your max, like your highest earning potential. If you look on the distribution of wages, 53 is right there at the top. Millennials and Gen Zers are the keep up generation. They're more so than Gen Xers because they have bought into.
They don't have a
TikTok.
high enough credit limit though to push their average up
Correct.
higher.
And they don't have the incomes to do it. But if you looked at their average, I would really want to know. Maybe we'll pull that out for the next show. Why is it, or what is their ratio of debt to credit card limit?
It's really sad. And it makes people stressed. And money should not be stressful. There's so many young people that we work with that no debt other than a mortgage, maybe a little bit of student loans. Everyone has some debt at some point. But if you were to survey our clients under 45 that are really on the right path for wealth building, they would tell you it's not that hard to accomplish what we've accomplished. You're intentional about a few very basic things. You execute those correctly, and it just tends to work out.
I met with a family last night, 64 and 61, net worth of $2 million. He makes a whopping $95,000 a year. And he asked his wife, he said, "Did you ever think we'd have a $2 million net worth? Ever?"
She probably said no.
They said, "No way. Never." And I'm going to this conversation because they still owe $100,000 on their house. Interest rate's 2.75. He interviewed a couple other financial advisors. Every one of them said, "Well, 2.75, you'll make more over here." So he asked my opinion. I said, "You should pay your house off. You got $2 million. Why would you have a mortgage?"
That's the common sense answer.
Well,
it's also the adult thing to do.
it's the best way to eliminate risk from his retirement situation. It's not always about the numbers. And ironically, when we first started, his first comment was, "I turned 64 in May. I'm going to take my Social Security in May." No part of it was, what's the best strategy? How do I maximize it? It was just, I would feel better if I took my Social Security in May. So when you asked me the question, I was able to turn it around a little bit and let him know that not all of his decisions needed to be mathematical in nature. And I used the Social Security as an example. I said, some decisions can be made because you feel good about them. We focus as an industry on optimal and best, and sometimes we overlook just the emotional factor of it. He's going to feel better not having a mortgage. And he was so relieved to hear it because no one had told him that. Everybody was just looking at it through a mathematical lens.
Everything would be much easier to optimize and maximize if we didn't have emotions to deal with. If you can totally remove your emotions, then yeah, just do what the spreadsheet says to do. But if you have a net worth of $2 million in a house that's paid off and easy cash flow needs to tend to on a monthly basis, what is there to be unhappy about in that situation?
Not really anything.
Peace of mind. What's your peace of mind worth?
I think it's
Probably worth more than whatever the difference is between 2.7 and what you could make in the equity markets.
For sure. Not every decision has to be the most optimal percentage return. And that's arbitrary. I flipped it around. I said, okay, you don't pay this house off and the market goes down 20%. Are you better? Well, no. My point. All the people you're talking to just assume it's going to keep going higher. And I do too. But if it goes down in the next 2 years, 20%, you're going to feel horrible that you didn't pay this thing off. You're going to be like, why didn't I pay that thing off? Seriously.
Yeah. And the 100,000 is going to be from gains if you have that much. So
it's irrelevant in this picture anyway. Before we run out of time, let's hit a listener question. I'm going to throw it to you to do it. The question is, I'm 45. My wife and I are contributing about 22% each to our 401ks, but not maxing them out. We are now debt-free and have about $2,500 a month extra to invest. We want to retire around age 57. Should we invest that in non-retirement accounts, or is it better to increase our 401k contributions? There's a lot in this, so let's summarize. We're not maxing 401ks, retiring in 12 years. We have extra money to invest. And I believe I know why they're nervous. And I'll throw that out there and let you ask the question. From what she's told us, or what he's told us, they're nervous about not being able to get at the money at 57 would be my guess.
that's my assumption as well from the question. So with this age and target retirement timeline, flexibility of where you can access funds starts to become part of the conversation. And in 12 years at $2,500 a month, you could build up a really nice size taxable non-retirement brokerage account. So I think there's a few things to clarify with this. What's the timeline? How much can I contribute? 12 years, $2,500 a month. You can build up a nice account. And their main concern is going to be, where does the money come from 57 until 59 and a half? I don't know what the 401k balances are in here. I don't know anyone who saves 22% of their income and isn't successful as an investor and with their money, especially at 45. They're probably making pretty decent income at that point. I think to really dial it in, you would need to do some planning. There's also a side of this where you make the argument for tax diversification. So assuming you're only offered traditional 401k, some of this extra money, you could start Roth accounts and Roth contributions over the next 12 years. What people need to remember what you contribute, you can take out without tax and penalty before 59 and a half. The growth has to stay in the account. That's what's subject to penalty. So those are really the things I would think through in this situation. What flexibility will I need? What's the tax diversification? And ultimately, to really simplify it, where's the money going to come from age 57 until 59 and a half? That's the bridge that we got to figure out how to build.
It's exactly what I would do. If you have a 401k Roth option at work, go max that out, the extra money, and plan on pulling it from the Roth, the basis from the Roth early. There are other options for people to get at the funds before 59 and a half. There are a lot of employers that offer what's called the rule of 55 that allows you to pull from your 401k. If you retire at that employer after 55, and they've told us it's 57, they'd be able to pull from the employer 401k without any penalty for the first 3 years, and then they could move that account to a self-directed IRA. But it needs to stay at the employer for that duration of time while they're pulling money to use rule of 55. The second option would be something called a 72T distribution, which is a way to get around the penalty before 59 and a half. It is a little bit more complicated to calculate. It's not complicated to execute. People get really scared about this particular strategy because it does require equal payments over 5 years, calculated interest rate. There's more moving parts. But we've done so many of these to help people retire that it's pretty straightforward what needs to be done to satisfy them. I wouldn't be concerned at this age about where the money goes. I'd be more concerned about putting together a plan that makes sure I can retire the way I want to retire at age 57. And then once I know that, I can figure out what to do with the extra $2,500. That's realistically what I would do. And I don't think there's any problem with allocating some of the money to a brokerage account, a non-retirement account. I don't think there's a problem with that. What I believe that does is adds diversification to what you're already doing. If we think about the best client outcomes we have, they have 3 buckets of money. They have Roth money, they have taxable money, and they have tax deferred money. And the reason it becomes important is it is a way to manage their taxes during their retirement and then ultimately throughout the rest of their lifetime. And that's why you pick different buckets. It's to manage taxes.
Age 45, 12 years out is a much better time to get this worked out than age 55 and 2 years away.
Valid point. Age 55, it just is what it is.
The situation's going to be the situation.
Right. At 45, you can make some nice changes and really set yourself up for getting out at 57 with the least amount of penalties, the least amount of tax, and all of the different things involved. This is a common question we get. We have a lot of clients who are in a good situation, want to retire early. I believe many people think they can't retire before age 59 and a half because of the taxes and penalties. And here's why I believe that. If we look at the data of how long people at age 45 tell you they're going to work, it's almost always past age 60. The reality is 26% of the population retires before 60 years old. But only 6% of the people believe they will when you ask them. I find it hard to believe that there's not a percentage of this population that retires before 60 that doesn't learn, oh, by the way, I can get my money out without a penalty. I believe that's happening.
It is happening. People just don't know.
They don't know what they don't know. And how would they know? Unless you're reading a plan document or listening to a podcast like this or doing some research, which the vast majority of the population doesn't do, how would you know about the rule of 55? How would you know what a 72T is? You wouldn't know.
You wouldn't. And then even if you came across it, would you really know where to execute it, how to ask the questions, who to ask the questions to? There's a lot of different moving parts. But it goes back to our point of this is an excellent question to ask at age 45 and figure out now. So then you're just working the path until you're 57, and then at 57, it's going to work out the way you want. And let's say you do all this and you get to 57 and you decide, I'm going to work another couple years. I'm having fun. I know I don't have to work anymore, but I still like it. It's better than needing to work because you aren't prepared.
We taught Passport to Retirement last Monday night. I brought this exact thing up. If everybody planned on retiring 3 to 4 years before they thought they would, we'd be in much better shape. Just think about it for a minute. Oh, I'm going to work till I'm 66. But statistics show us most people retire earlier than they thought they would. Why wouldn't we be planning saying, I understand you think you're going at 66. Let's plan on 62. What's the downside of that? There is no downside other than you would have to likely sacrifice a little bit of lifestyle now, and probably not a lot if you start young, to have security you could retire at 62. As you said, if you want to keep working, great. It's how I approach my financial independence. We've talked about it on the show. I'm part of the 30% that say they'll work till 70 or never retire. Reality is,
yeah, you are.
I am, but I'm not preparing that way. I'm preparing as if I'm going to be part of the 26% that goes before 60, even though that's not my intent. So what's the worst thing that's going to happen? I get sick or something happens. I have to go at 62. Oh, okay. It'll all work out. But if I plan on 70, I have to go at 62. There's almost no way that's going to work out unless you just lucked into it.
You might get lucky.
I mean, there is an old saying, better lucky than good.
Sometimes that's true.
Well, with that said, we'll wish everybody a happy Halloween. If anybody has any questions for the show, feel free to throw us an email, click the link in the description. As we discussed earlier, if you're nervous about buying at all-time market highs, we've got the downloadable guide that kind of should walk you through getting over that fear. I want to thank everybody for listening, and hopefully you tune in the future.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Consult your tax professional about eligibility to Roth and traditional IRA contributions. Contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59 and a half and has held their Roth IRA for at least 5 years.